Joining us now, Chief Global Market Strategist at Invesco. Great to see you, Kristina. I feel like most of our conversations continue to center around similar themes, but this does continue to feel like the dominant story as we head into the fall. What have you been talking about with your clients?
John, absolutely. The Fed is the dominant theme because it really has dictated so much of what has happened in markets in the last more than a year. And so, of course, it is the primary question that we get from clients. And of course, I answer that I believe very strongly that we are at the end of the rate hike cycle, that all signs point to a very strong disinflationary trend, as well as a real, we're seeing some weakening in the economy, but in a good way, because the Fed didn't want to see an overheating. So we're at a place where I think the Fed can be comfortable ending the rate hike cycle.
So how has that influenced how you're strategizing around investments right now?
Well, I think that once there's clarity, right, this is my conjecture, but once there's real clarity that this is the end of the Fed's rate hike cycle, because we did hear them talk a little hawkish at Jackson Hole, but once there's clarity, I think that's when markets can start to anticipate an economic recovery. They'll look ahead, even though I think we're going to get a bumpy landing. And so that discounting process means we're likely to see better performance from more risk-on areas of the market, from smaller caps, from cyclicals, within fixed income, high yield. And I think this is a time when we're going to see areas outside the U.S. perform better, including emerging markets equities and emerging markets debt. International equities in general, because I think we're going to start to see the U.S. dollar weaken. So this is the kind of environment that's likely to kick in soon, even though until then we'll have some uncertainty and some volatility and a lack of really strong leadership.
Well, it's interesting to hear you say some of that because the Canadian market, as you know, is more tied to, let's say, commodities, certainly the financials, which we just got a taste of how the banks are performing right now. Would you see the possibility of a Canadian market, even with the economic uncertainty that we're having here, being better positioned than, say, the U.S. market at this stage of the game?
Well, that's a great question. And I think in some ways, yes, because I would anticipate cyclically sensitive commodities performing well in this environment. Of course, it's going to take a little time to get there, and the bumpy takeoff that China is experiencing isn't helping in the near term. But I do think we're going to see commodities perform better. And banks, at a certain point, will start to perform better as well. This is a difficult point in the interest rate cycle for banks, so there's certainly some headwinds. But yes, as we look out a year, I do believe that it is well positioned.
We only have about 30 seconds, Kristina, but you're painting a relatively optimistic picture. There are some people who continue to speak about this interest rate environment, even if we're near the end of this cycle, leading us to some very potentially dark waters for the economy as we head into next year. But it sounds to me like you don't fully buy into that idea.
I don't buy into a soft landing either. I think what we're going to see is a bumpy landing. But employment is so strong, so many consumers are employed, that it's hard to envision a truly hard landing. What I think is far more likely is that middle of the road scenario in which we get a bumpy landing. Certainly there are going to be real effects from the tightening of credit conditions and all the other collateral damage created by such an aggressive rate hike cycle.
Kristina.